Good morning, good afternoon, and good evening, and welcome once again to Jedi Tax Online, December 5th, 2021. Tonight's episode, Investing 101 Mutual Funds. We're going to be taking a look at specifically what mutual funds are, and we're going to spend time on some specifics related to them, but we're going to come up with some simple definitions on them. And I just want to say hi, that's me. Hi, I'm Rogelio Noriega. So thank you for joining me. And of course, as we get going, the most important thing, we have to refer to the what we call the Selena rule here. And I know it is difficult to read and how apropos it is legalese, but basically, you need to understand that we are not rendering advice. The information obtained within the website, this program, is provided for informational purposes only and is not intended and must not be taken as a substitute to obtaining accounting, tax, legal, or other professional advice from a tax resolution professional, such as an enrolled agent, CPA attorney, etc. Presentation of the information via this norm, the internet, is not intended to create, and receipt does not constitute a tax professional client or attorney client relationship. Internet subscribers, users, and online readers are advised not to act upon the information without seeking the service of a tax resolution expert. Accuracy of the information, of course, contained in this product is provided by Jedi.tax. While we endeavor to keep the information up to date and correct, we make no representations or warranties of any kind, express or implied, about the completeness, accuracy, reliability with respect to the website, this promotion, program, product, services, or other related graphics contained herein. Any reliance you place on such information is therefore strictly at your own risk. We assume no responsibility for any errors or omissions in the content of the website or such other materials or communications. We've got to put it in there, folks. It is illegal stuff. There is no warranties or limitations. You got to know. And of course, any links to third-party websites, you go on there on your own, and we will mention them at the end, but that's just the way it is. So you can take a look at it. I roughly went over it. It's this. There is no attorney-client relationship here. So we're going to go ahead and move on this one. And basically, as I mentioned, what are we talking about? Oh, and that's the one that I didn't want to get to. That is the one slide I messed up on. Well, actually, I probably messed up on others. But what is a mutual fund? It's an investment program funded by shareholders that trades in diversified holdings and is professionally managed. What does that mean? A mutual fund is a company that brings together money from people and invests in stocks, bonds, or other assets. The combined holdings of stocks, bonds, or other assets, the other assets being properties such as buildings, rental properties, or other sorts of investments, can be classified as an asset. The combined holdings of stocks, bonds, or other assets to fund own are known as its portfolio. This is the definition from the Securities Exchange Commission. A mutual fund is a company that brings together money from many people and invests it in stocks, bonds, or other assets. The combined holdings of stocks, bonds, or other assets the fund owns are known as its portfolio. Each investor in the fund owns shares, I believe it is, forgive me a moment, which represent a part of these holdings. Oh, I can't believe it came across like that. From the Investment Company Institute, and I did not put them in the credits. Anyway, I'm giving them credit here. Mutual funds make it simpler to invest. Diversifying by buying lots of different stocks and bonds can be costly and time consuming. Most individual investors prefer a simpler, less expensive way to diversify, hence buying mutual funds. Mutual funds are managed by professionals and invest according to clearly stated investment objectives. Depending on their investment objectives, mutual funds can hold a mix of stocks, bonds, or other assets. As I mentioned earlier, other assets can be properties, and or other things. I know, huh? I know, huh? What are mutual funds? People talk about them. There's a mutual fund yearbook 2021. Money gives you an investor's guide, which is on stocks, bonds, and mutual funds. US News gives its yearly ranking on the best mutual funds. And of course, you can even buy the Mutual Funds for Dummies. Yep, the book is out there. There are companies that sell their branded mutual funds: Fidelity Investments, Oppenheimer Funds, MFS Investment Management, Janus Capital, and Putnam. I have had investments in Janus in the past. I do not have any right now. Also Invesco, which I've also had in, as well as Franklin Templeton, and I currently have investments in Franklin Templeton. Charles Schwab, American Century, and boy, there's still quite a few more. SBI Mutual Fund, Nippon Indian Mutual Fund, DSP Mutual Fund, DBI Access, DFC, Franklin Templeton, HDFC, L&T, UTI, HSBC. It just goes on and on and on. These are companies that offer different ones. I believe Franklin Templeton, which is the one that I'm most familiar with, has over 200 different types of funds. Investment companies are not the only ones. Wells Fargo, Citi, Bank of America through Merrill Lynch, US Bank, just to name a few, also offer mutual funds. So for those of you that are banks and have bank relationships, you can contact your bank and see what they offer. There are many types, as I mentioned. There are what we call equity funds, debt funds, money market funds, hybrid funds, gold funds. Gold funds just, it's a sector fund, what we would call, but we'll get to that. There are many, many types. You have mutual funds. Some are based on maturity period, others on investment objective. We're going to be spending a lot of time on the investment objective and just tangentially refer to those that are based on maturity. We will be mentioning them. The first type of investment objective that we're going to look at is equity funds. What are equity funds? Well, there are tax saving funds, index funds, a sector fund, and a diversified fund, which come under the equity heading. A tax savings fund, it invests in securities that are tax-free or state-free. I'll give you an example. I've talked about it in the past. If you invest in, say, Franklin Templeton California Tax-Free Income Fund, and you are a resident of California, such as I am, you do not pay taxes for federal or California on dividends and capital gains. What do they invest in? California state debt. They also invest in California municipal debt, such as cities, counties, and districts, such as the Metropolitan Water District, stuff like that. Equity funds are those mutual funds that primarily invest in stocks. You invest your money in the fund with an SIP, and if I remember correctly, an SIP is an investment over a specific period of time, whether it be monthly, weekly, yearly, quarterly. I think I already said yearly, so I was going to say annually, but you can do that, or lump sum, which is some funds require $1,000 minimum, others $2,500, others $5,000, $10,000, whatever. That would be your lump sum, and you don't have to invest again, which then invests it in various equity stocks on your behalf. The consequent gains or losses accrued in the portfolio affect your fund's net asset value. I really didn't talk about net asset value, but basically, at the end of the day, the mutual fund adds up everything that it has and divides it by the number of shares outstanding, and that's the net asset value, what it's worth on a daily basis. But you don't get the net asset value until the next day. But that's a specific thing that we can talk about on another day. Sector funds. If I'm not mistaken, that's where we are right now. The writing is a tad small, so I ask you to bear with me. But a sector fund is an investment fund that invests slowly in businesses that operate in a particular industry or sector of the economy. Sector funds are commonly structured as mutual funds or exchange traded funds, ETFs. I'll get into that near the end. Themes to consider in sector funds. A sector fund is an investment that invests in one type of industry or sector. Sector funds are usually available as mutual funds or exchange traded funds, ETFs. There is more volatility in sector funds because they focus on only one area of the economy. Think of all gig or all technology, and you invest all in technology, and the technology sector takes a dump. Your entire value will take a dump as well. There's no diversification. That's what sector funds do. You like real estate investment trusts. A real estate investment trust, and I'm starting to get off of it now, is there are mutual funds, and I do have a real estate investment trust fund. What that is they're specifically investing in properties that generate earnings or can generate capital appreciation. What does that mean? Capital appreciation, which I believe I'll get into the definition later, but I'm going to give it to you now, is I buy in at $1,000. I believe it's going to go up in value. It's going to appreciate value. So that is growth in addition to income earning properties. I'm on sector funds still. Sorry. Investing in sector funds can be done through active management funds or through passive management funds, the latter of which usually follows sector specific indexes. This is the first time I actually upload the presentation directly to StreamYard. It's really working. I'm really liking it. I wish I could move my. Actually, I think I can. There I am. Let me know if it changes, but I'm not blocking the wording out. A diversified fund is an investment fund that is broadly invested across multiple market sectors, assets, and or geographic regions. There are fund companies that say, excuse me, they don't say excuse me, but excuse me, they invest in India, they invest in China, Mexico, specific locations, or they can invest in Asia, they can invest in Europe, Africa, South America, etc. Those are the geographic locations. It holds a breadth of securities, often in multiple asset classes. Its broad market diversification helps to prevent idiosyncratic events in one area from affecting the entire portfolio. In other words, if this fund invests in, say, energy stocks, production stocks, financial stocks, banking stocks, if one takes a dump, the rest of the fund should be okay. You'll get a little bit of a bump, but it generally will do well, as opposed to investing in a fund that just invests in financial companies or accounting companies, whatever. And they do exist. And if the industry is doing bad, the fund value will go down and your investment will take a hit. Things to consider. Diversified funds refer to pooled investments that build portfolios across several asset classes, regions, and or industry sectors. Diversification is a key investment strategy for reducing systematic risk in a portfolio while maintaining levels of expected return. Diversified funds can range in focus from passive index funds that replicate broad indices to actively managed funds that invest broadly. I'm beginning to use a lot of words here that you probably are not used to. Broad indices. Usually indices refer to, well, it's index in plural, indices such as Dow Jones, NASDAQ, and the other one that's out there in the United States. Oh, I cannot remember it. There's three. Oh, S&P 500. Dow Jones is a set of indices. Industrials is the most famous one because America was an industrialized nation. It's less so. But the Dow Jones Industrials is just specifically industrial or companies that produce a product. And it's a measurement of the industrial base in America. That's not the only index. There's many others. But that's the one that people generally follow is the Dow Jones industrials. But as I mentioned, there's NASDAQ and S&P 500. We're now going to take a look at debt funds. It's another investment objective. And what are they, or what are their formats, or what they come in? Liquid funds, gift funds, corporate bond funds, short term, medium term, and long term funds. They're also dynamic bond funds, which I'm not overly into, and I've not uncovered any of them. I've never really come across an investment opportunity in a dynamic bond fund. I know what it is, I understand what it is, but no experience whatsoever. But I've been in short, medium, and long term funds, and corporate and gift funds and liquid funds. Definition of a liquid fund is, or are types of mutual funds that invest in securities with a residual maturity of up to 91 days. You might want to consider that to be something like not a savings account, but those, oh my goodness, when you go to a bank, a CD, a certificate of deposit. They have a maturity of whether it be 30 months. I'm sorry. Well, there could be 30-month CDs, but usually they're 1 year. There could be 6 months, 1 year, 2 year, 3 year, 4 year, 5 years, whatever. That's what a residual maturity of up to 91 days. Assets invested are not tied up for a long time, as liquid funds do not have a lock-in period. An investor looking for better returns prefers investing in a liquid fund over a fixed deposit. Gift funds, and I narrowed it to children's gift funds, are a type of mutual fund scheme. I don't like the word scheme because of its of a negative connotation, but these funds are positioned at funding various life events of children, such as higher education and marriage. Children's gift funds are classified under hybrid or balanced mutual funds. Corporate bond funds, and I'm sorry, it is getting a little, the wording is getting a little small there, so I'll read it. Most bond funds are comprised of a certain type of bond, such as a corporate or government bonds, tangentially mentioned earlier, and are further defined by time period to maturity, such as short term, intermediate term, and long term. Some bond funds include only the safest of bonds, such as government bonds, the U.S. government, U.S. treasuries. Investors should note that the U.S. government bonds are considered to be the highest credit quality and are not subject to ratings. In effect, bond funds that specialize in U.S. Treasury securities, including Treasury inflation protected securities, otherwise known as TIPS, are the safest but offer the lowest return potential. Other funds invest in only the riskiest category of bonds, high yield or junk bonds. Bond funds invest in more volatile types of bonds tend to offer higher potential returns, but of course, a higher risk. And that's the thing. It's going to be a higher risk. Short, medium, and long-term funds. An immediate term, which I threw in, is less than or equal to 1 year. A short term is more than 1 year but less than 3 years. A medium term is 3 years but less than 8 years. And a long term is more than 8 years. And then good old Rogelio decided to get into the definition of that. Remember, these timeframes do determine market suitability, risk appetite, expected returns, form of investment, etc. An immediate term equals less than or equal to 1 year. For immediate returns, money market serves ideal as it ensures adequate liquidity and lower sensitivity to market risk investing in equity instrument. And I believe this was a bit of a mistake on my part where this is the only time where I mentioned money market funds. And I don't believe I mentioned anywhere else. But a money market fund is having a glorified savings account. It invests in items which are short term, readily available, and you're able to get your money out. Usually, a money market fund maintains a dollar value of 1, and it does not go up and does go down. If it goes down, the fund might not be doing very well on the very safest of investments. Short, medium, and long. Now I talked about the short, which I said is more than 1 but less than 3 years. In short-term investments, risk taken should be higher than in immediate terms. It should include a fair mix of short-term debts, money markets, income funds, and equity investments to increase the opportunity of earning higher returns. Higher exposure to equity and short term investment is not advisable. This one, and I apologize for the way it shows up on screen, and I'm so sorry for that. I can see there's a problem on screen, and I do apologize. A medium term, as I mentioned, is more than 3 but less than 8 years. Higher, moderate to higher amount of equity investments is advisable for midterm investment time horizon and is suitable for the equity markets to provide returns while adjusting to market volatility. All big words. Besides equity market, debt type investments should also be considered to provide much needed stability to the investments. Long term or more than 8 years. I don't invest in it. Actually, I take it back. I am invested in some items. USA savings bonds. Those are long term funds. An idea of a long term fund, which could be found in a money market fund. But that's giving you an idea. I do have an investment in something that's more than 8 years. Long term investment tenure is suitable for a higher equity exposure in the investments. In the long run, long term investments are avenues of higher returns as compared to the immediate short or medium terms. In other words, and the best way I can equate it is this: if you sign up for a CD with your bank right now, your bank is probably going to offer you 0.02% for 6 months. For a year, they may offer you 0.03, which is not even 1%, folks. If you will keep the money there, and thank you, Thomas, for the like. If you keep your money there longer, the higher the return will be. So if you keep it there for 2 years, they might give you 0.5%. If it's 3 years, probably goes up to maybe 2%. That's what they're talking about right here. The longer you are willing to secure your investment with them, the more they're willing to pay you because it's secure for them as well. Now, on a CD, if you take it out early, there is a fee you have to, early withdrawal fee. In order to solve the purpose of diversification, investing in equity is not enough. One should also consider debt investment to withstand a market volatility. The overall purpose of investing your hard-earned money does not end by only deploying it towards an investment avenue. So even then, even though I'm talking about in mutual funds being good, it really shouldn't be your only one. It requires a broad assessment of individual needs and appetite to bear the tough market situation. How much can you bear? I had to learn to invest. In 1992, within 1 year of working for my present employer, I invested in mutual funds. I invested in American Century, back then known as 20th Century, Invesco, Janus, and Franklin, 4 mutual fund companies. And I wrote it out every day. And if my fund moved up a penny, awesome. And if it moved down a penny, I lost money, allegedly. Well, allegedly. You only lose money when you buy or sell. But when it goes up and down, the best thing you can do to learn to invest is buy a mutual fund. Or invest into a mutual fund. And then you can learn what your risk profile is. In other words, how much can you handle? Can you handle the ups and downs on a daily, on a monthly, yearly? Mutual funds make it easier for you not to worry about that stuff. But anyway, that's an opinion. One has to understand the return potential in the investments, as the expectations should not be over exaggerated while initiating investment processes. When your friend tells you they have a sure thing, you need to be careful. Dynamic bond funds are a class of debt mutual funds that alter allocations. The word allocation, which I've used before, is where the investment is putting its money. Allocates, in this case, between short-term and long-term bonds. This strategy helps in taking advantage of fluctuating interest rates. A bond is what we call a debt instrument. An equity item is such as stocks. It's a certificate, it's actual ownership in something. Going back to dynamic bond funds, this strategy helps in taking advantage of fluctuating interest rates. Now, we're switching a little bit on the investment objective to hybrid balanced fund. You have three types of hybrid balanced funds. And again, they're still mutual funds. You have monthly income plans, which are called MIPS. Whew. Fixed maturity plans, fronts, actually FMPs, and capital appreciation fund. Monthly income plans. Monthly income plans are hybrid funds which primarily invest in fixed income securities. Fixed income securities are bonds, basically. I have a comment from Thomas, and they don't. I'm not sure at what point the comment was there, and I apologize. A small portion of their corpus to equity and equity related instruments. This allows these plans to generate better returns than pure debt schemes and allows the fund to offer regular income to investors. Fixed income securities, generally CDs, bond funds that, oh, yes, there is no such thing as a sure thing. That is correct, Thomas. Thank you. That is 100% right on. This a fixed income security is that a bond with a maturity date. I've mentioned CDs, banking instruments. Yeah, those are generally the ones. Fixed maturity plans, commonly referred to as FMPs, are a class of debt funds that primarily invest in fixed income instruments such as certificate of deposit or bonds that lock in the yields that are currently available. Fixed maturity plans are closed-ended mutual funds with a predefined maturity. That's some pretty tough legalese. Closed-end funds. I ask you to put it in a pin, and we're going to get to that near the end. ETFs and closed-end funds. And I apologize for doing that. Capital appreciation plans, which is the next one, also known as capital gains, refers to the increase of an investment's value, as I mentioned earlier. A capital appreciation fund is a fund that attempts to increase asset value primarily through investments in high growth and value stocks. Now, high growth and value stocks are usually companies that are smaller, usually, doesn't have to be. Let me give you an example. Microsoft. This is not a high growth, but I believe it is a value stock. A high growth stock is one where you see the value, they're growing big time. It's just growing. Anheuser-Busch, now owned by InBev, those are not high growth, but they are value stocks. These funds may also be called aggressive growth funds, which are capital opportunity funds or capital gain funds. And there it is, the definitions. I mentioned an ETF, an exchange traded fund. ETF is a type of security that tracks an index, as I mentioned earlier, an index such as NASDAQ, S&P, Dow Jones Industrials, but there are others in the Dow Jones, and there are other indices around the world. Index, sector, commodity, or other asset, but which can be purchased or sold on a stock exchange in the same way a regular stock can. Remember I mentioned net asset value earlier? Well, no. The net asset value is determined at the end of the day, and the next day, that is the price of the mutual fund. On an exchange traded fund, it has an immediate value throughout the day, and it can go up and down. So it's just like a stock. An ETF can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities. ETFs can even be structured to track specific investment strategies. And as I mentioned, the other definition, a closed-end fund. A closed-end fund is a type of mutual fund that issues a fixed number of shares. In other words, when they start out, they have 100 shares, that's it. That's what they're going to sell, and that's what's going to be traded on the open market through an initial public offering, otherwise known as IPO. For those of you that have seen The Wolf of Wall Street, when he explains an IPO, it is absolutely brilliant. It's really well done. An IPO is generally to raise capital for its initial investments. Going public. Its shares can be bought and sold on a stock exchange, but no new shares will be created and no new money will flow into the fund. That's what a closed-end fund is. In contrast, an open-ended fund, such as most mutual funds and exchange-traded funds, ETFs, accepts a constant flow of new investment capital. It issues new shares and buys back its own shares on demand. Many municipal bond funds and some global investment funds are closed-end funds. So, that, I hope, has given you an idea of what a mutual fund is. I presently own 4 mutual funds, and specifically only in Franklin, Templeton. If you want to know what I'm invested in, you can contact me. I'll share where I'm at. But I am running at about 13% on my Franklin Utilities Fund since inception, which was sometime in the middle of last year. I'm running at 37% up on my Franklin Real Estate Investment Trust Fund. But on my California Tax Income Fund, one of them, I forget the number, I'm running at like 0.005 minus. That's the one I've only owned for about 4 months. They're only $100 in that one, so yeah. The other one is the Franklin California Tax-Free Income Fund. I have about $500 in that one, and I'm running at about 4%. But that is a bond fund, and that one specifically is only debt instruments in California. But whatever I earn on that one, it's tax-free. For those of you that remember, back in 1992, and we just died when Ross Perot earned $1 billion tax-free and $1 billion didn't pay taxes, it's because he owned bonds in the state of Texas, as well as not only state obligations, but as I mentioned earlier, over here, the Metropolitan Water District, that's one, for instance. County agencies, city agencies, or municipalities. He had that much invested where he earned $1 billion and it was tax-free because he had reinvested in the state. You can do that too. You can reinvest in your state, buy general obligation bonds directly from the state, directly from the city, the municipality. But you got to have money to do that. They go for like $10,000 a shot. For some people, that's nothing. For myself, that's a lot. That's a lot. So you can see what you want to do with that. If you guys want to talk investments with me, be more than happy to. But I want to go over this stuff now as we end. Folks, I need likes desperately on the Jedi Tax channel on YouTube. Once we get to 100 likes, I can change the domain and you don't have to do a search for Jedi Tax on YouTube. But I am on YouTube. We are on Facebook, our page, which you're probably looking at it on this one. Actually, no, let me take a look. You guys are looking at it on I think it's my public page or my private one. I don't know which. And our NDB Media Twitch page. Thank you, folks. But this is where we are. www.jedi.tax, Facebook, YouTube, Instagram. Now, you see my initials. You've seen them throughout. What is a CRTP? I did this last time, so I'm quickly going to go over it. I am a CRTP. I'm also an RTRP, and now I'm a CAA. And God willing, I will have an NP as well. The NP is Notary Public for California. I am not a Notary Public today. That's why I don't have that acronym following my name. But I have my certification. I'm really proud of it. This was the application. This is a copy of the application. But there it is for my CAA. I'm really happy about it. Nice. It's got a little sticker there. So it's real. That has gone to the IRS. I went through CNC Financial Services. So I am a CAA, which is a Certified Acceptance Agent for the IRS. So I'm really happy with that. That's going to translate to a little bit. But anyway, what is the CRTP? Well, the CRTP designation comes from the CTEC, ctec.org, which is the California Tax Education Council. And you can check that link to check on us, see if we're legal or not, or if we're real or not. And you can even see that link, which is what is a CRTP. All CTEC registered tax preparers must complete 60 hours of qualifying tax education from a CTEC approved provider. We have to pass a background check and live scan. We have to obtain a PTIN, which is a preparer tax identification number from the IRS. We have to purchase a $5,000 preparer bond. So that's the bare minimum. I also have errors in omission. I also have internet. I have to register with the CTE within 18 months from completion date on the certification of completion. I have to pay a registration fee with the CTEC of $33. And to renew all registration of CRTPs must complete 20 hours every year, maintain a valid PTIN from the IRS, which now costs us money, rat bastards, maintain a $5,000 tax preparer bond, renew the registration by October 31st of each year, and we pay a renewal fee. That's just in California. So, darn it. It changed. I don't know why you can't see it, but that's my fault. So, CRTP means California Tax Education Council Registered Tax Preparer. That's what a CRTP is. And also, I mentioned I have the RTRP and CAA. What are they? And I apologize for this. These mean they're IRS designations that I'm a registered tax return preparer with the IRS, and I have ITIN. I am an ITIN certified acceptance agent. Wow. All right, got to get that in there. Credits, thanks, and you know who? Investopedia, Google.com, Grow.in, Investopedia. I put them twice. Don't know why. Merriam-Webster.com, the Oxford Languages, Scriptbox.com, Wikipedia.com. Of course, we used NDB Media as well, and Jedi.tax. So, upcoming episodes on January. Oh, way to go, Raj. It's not January 9th. It is, or December 9th. It is December 19th. So I apologize. December 19th, we're going to be doing an episode on Social Security. On January 9th of the new year, identity theft and identity protection. January 25th, of course, tax preparation prep. What you need to do your taxes. February 27th, we're going to do life, medical, and disability insurance. I hope to have an insurance agent with us. I am not an insurance agent yet. Couldn't get it done. Got to do it this year, 2022. We're going to be doing an article on consumer health, budgeting, financing, planning, stuff like that. And then we're going to carry over to April on life plans, having a plan for a plan. On June 5th, 2022, we're going to continue with Investing 101, and we're going to talk specifically about stock ownership. Again, we barely mentioned it here because we were looking at mutual funds. So, on July 3rd, we're going to be talking about purchasing property, specifically home ownership. So that gives you a rough idea of what we have planned. Those programs are on calendar. I may add more as are necessary. We'll see. So, but that's what's on calendar for now. Please take note. December 9th episode should be December 19th. So we're going to continue. And as I mentioned, the Selena rule, there it is. It is in legalese. Again, there is no attorney-client relationship with us. There's nothing. This is all for information purposes only. You take any risks should you do whatever you want. There is no implied liability or warranty. There's nothing. We're just providing you information. If you're going to, oh my goodness, if you're going to take use of it, oh, I'm so embarrassed. I just realized I'm using my persona from Sports Talk with the Guys. I just realized it. I am so sorry. I am so embarrassed right now. I cannot believe I did that. Oh, well, at least I'm going to try to change it to the very end. At the very end. Oh my goodness. I cannot believe I did this. This is embarrassing. But like I said, I get to add a whole bunch of acronyms at the end of my. It's way too much. Rogelio D. Noriega, CRTP, RTRP, CAA. Thank you, Luis. Thank you for the like. Appreciate it. The Selena rule, that's what it is. So today has been our episode on Investing 101 mutual funds. Today, December 5th, 2021. There it is again, Rogelio Roger D. Noriega. I'm a CRTP, RTRP, and a CAA. And within the next 2 months, I will be adding NP to that as well. I have 34 years of experience in financial planning. And as of January 1st, I bumped that up to 35 years. Wow. Really excited about that. That will end this program. Thank you. I appreciate your comments. Please let me know if you have any questions. Drop it in the comment field here. But Jedi Tax Online, next episode will be December 19th. I thank you. Good luck and good night.